So we had quite a good rundown on macro.
I mean, they're selling an emerging market fund and then bullish
emerging markets.
I mean, funnily enough, they are bullish.
Yeah.
It was good actually. It was good.
It must be good because I've come out of there very built up on emerging markets, which is usually the way of things, right?
I was in a meeting this morning with an analyst, collectors analyst, who was also bullish emerging markets.
Yeah.
Was it our emerging and Asian market analyst?
No, it wasn't actually. It was somebody else.
What was the TLDR?
They're really cheap. You
They
can
are
buy
really
good
cheap.
stocks on single digits.
China's on 8 times.
Mm.
Bit of political risk.
Bit of political risk, bit of property ownership rights, confiscation type risk.
Well, funnily enough, the EM manager did mention this. He said, I mean, it's not like they're about to steal all the AT1s off their largest bank.
No, only the Swiss do that.
Yeah, exactly.
I mean, give it 5 years, people will be buying that stuff again, like it's going out of fashion. People have got very short memories.
They're yielding 10-12% though.
The cocos? Okay, explain what a coco is.
What contingent convertible or convertible contingent? Basically,
Contingent
it's a
convertible,
bond, and it's like a normal bond, except if the bank goes through a liquidity event and they convert to equity.
Yeah.
But the problem for Credit Suisse was that in the prospectus of the Credit Suisse AT1s, they had the ability to write them down to zero and not give them any equity.
The problem was no one had read the prospectus properly.
No, well, who does?
I read prospectus start to back up for every stock I ever invest in.
So I think the Swiss
Absolute
banks are the only ones that had that clause in, interestingly.
Have you got your teams off this week?
I have. No one's ringing
calls.
me against
No
about
calls this week.
81s. Yeah.
Cool. Right, let's get stuck in. Welcome, episode 4, taking stock after the bell, although we're a little bit earlier this week, so not after the bell, during the bell, before the bell. Jonathan Raymond, investment manager. James Hughes, investment manager. And, better or worse, Dave Henry, investment manager. How are we doing, fellas? Tax year end stuff all sorted?
All done, and it's a delight. It's been a stressful few weeks. I did have a SIP contribution yesterday, but we did manage to get the forms done and the payment made, I'm hoping. So everything's done. But we start the new year. It's always good to start the new tax year, isn't it? We've done the work for the last
Wealth management Christmas, the last day of the tax year.
No, it is.
And then you can. Is it Thursday? Is the 5th or 6th? You can go around saying Happy New Year to everyone. This is the best joke in the world.
For more banter like that, stay tuned. Right, OPEC. OPEC cut by 5. The Saudis cut by 500 million barrels a day, wasn't it? So we've seen a little bit of a pop there in the oil price. You can see on that chart is oil price after over the last 12 months. We've had a little bit of a wiggle in the last couple of weeks. First up, does this matter?
It's quite interesting because there's been quite a lot of pushback, hasn't there, on them essentially causing the Western inflation problem again. But the US have obviously been releasing reserves, and they were quite clear when they started releasing reserves that when the price of oil fell below, I think it was $75, they'd stop doing it,
back, yeah.
and they just haven't.
No, they had a chance to start. They were going to start buying back to refill the reserves, which they didn't quite manage to do.
No.
So maybe this, I don't know. I mean, it's potentially quite a defensive move by OPEC Plus and the Saudis to try and hold the price up, recession risk, and that's why the oil price has fallen quite materially in the last 12 months, right, or 6 months certainly, is because people are worried about recession, and recession is not good for oil demand.
So explain, for people that might not be familiar with what OPEC is, what it is, how they control basically the oil market.
Is it about 40% of the oil market OPEC control? Plus, but maybe it's 50.
Yeah.
So it's basically Saudi Arabia, Iraq, Iran, Libya, Egypt, Russia, and somebody else in there as well. Venezuela. And they're effectively a cartel, so they have a quota each as to how much oil they can produce on a monthly, annual basis. And global oil demand is about 100 million barrels a day, and so a 1.5 million barrel cut is 1.5% out of global supply, which is not immaterial, but it should bring the market back into balance in the short term. That's the idea, which is why the price has firmed up, nearly 10% in the last week. So, but the price is still way down on where it was even 6 months ago. So
yeah, and as we've discussed, we were talking about this on the desk this morning. I was speaking to my colleague Sam about it, and I can't remember which podcast he was listening to, but this idea was floated. If the problem over the last 6 to 12 months has been services inflation rather than goods inflation, and this is a little bit of goods inflation, we all know what a knock-on impact there is in the US consumer with higher gas prices.
Yeah.
Maybe this is actually deflationary?
Yeah, well, it's often discussed like that, isn't it? Higher gas prices is deflationary because it leaves less money in people's pockets to spend on going out and having fun, as we've discussed in podcasts.
Cost of funds the problem. Get the cost of goods back up again, maybe that'll be the problem again.
Yeah.
I mean, it's difficult for me to see, unless this obviously becomes something bigger than it is. It doesn't really feel like a massive deal to me necessarily.
Not at the moment.
No, I don't know. It hasn't majorly moved markets, with the exception of some of our oil majors, which was quite nice to see them pop yesterday.
We'll get on to those in a second, because I think there's something interesting to pick at there with the oil stocks. James, I think it was maybe you shared this chart, the commodities, the equity, basically. We seem to go through, or have gone through, cycles since 1970 of commodities doing much better than stocks.
Yeah.
That reversing, and that trend seems to keep happening, and obviously the implication from this is that we're at a bit of an inflection point again.
Well, I think
I'm surprised that line isn't higher, actually.
I know, but if you think, I mean, we've just been to a meeting with an EM manager, and we were talking about the cost of oil, or the cost of fuel as a percentage of global GDP. I mean, that's massively come down. I think the figure was 7% in the noughties, and it's something like 3%.
Yeah, 3.3 wasn't it?
Yeah, but actually, if you look at this chart, it, we literally just discussed it. It sort of goes in tandem with what's being produced and which businesses are in vogue. Where you've just had a period where essentially you need very little capex spend to create the next application or tech business or whatever else, and actually the building stuff, there's been very little. If you look at where commodity prices have been, I think that peak is that 2009-ish. Actually, if you look at that period there to where we are today, it's all been about the mega tech businesses and
intangibles.
Yeah, exactly. Whereas I think where we are today, and we were just talking about the need of copper for electric cars and lithium for batteries, and there's potentially some reshoring of businesses. Actually, I think that capex spend and the businesses associated with them, that it has every chance of increasing, because as we build stuff out again, actually properly build, whether it's manufacturing or buildings or mining for materials, you're likely, the view from here looking at that chart is the price of commodities compared to equities should rise, and actually a different type. And we spoke about it in our first podcast. Our view is the next 10 years will look very different to the last 10 years in terms of the type of businesses that drove those returns.
This is all part of it, isn't it?
Yeah, absolutely.
If that, if this is a turning point and commodities start outperforming the equity markets, then portfolios will look very different. Interest rates are going to be higher, inflation is going to be higher, and we need to do different things.
Yeah. And obviously, the last time we had this driven down from where commodities were very expensive to where there was a tech bubble, it's exactly the same sequence of events as has been the case from 2009 to where we are. You had the next dot-coms, you had the
Cisco.
Exactly, AOLs and whatever else in the last one, and this one is quite similar. It was however many companies that produced with massive valuations with no revenue.
I don't think it's a done deal that commodities start outperforming from here. It's not. This is just that. This is a sort of us positing and theorising as to how the next 10 years look.
Yeah.
And lots of evidence does suggest that we're going to go through Lombard, TS Lombard call it the tangible 20s, back to building stuff, energy, transition, climate change.
I like that.
But also,
nice
and we've had the intangible 10s, right, with the Microsofts and the Amazons. It's a nice, neat theory that fits around lots of these sorts of charts. It's not a done deal.
JR's just said what I babbled about for the last 2 minutes in about 10 seconds in a far more succinct way, so we should just listen to what he said.
That's the point I was going to bring up next. I feel like, I don't know whether it's just recency bias or just me noticing this more and more. It seems to me more when you're talking about investing, there's two sides to things. So there's tangibles versus intangibles, there's growth versus value, there's tech versus non-tech. People feel very polarised between those two camps. Is that do we think, not quite honest debate, that's a bit much, but do we think social media, the ability to debate people online has made people more polarised in their opinion, which I think is a pretty dangerous thing to be as an investor?
I mean, certainly the bots behind it will push you down a rabbit hole, as we all know when you're sitting there for a quick scroll of the phone and 2 hours later you're in somewhere very different to where you started. Moving on.
Swiftly. I don't know. I mean, human nature though is right. We want to be able to. We want to be able to bet on an outcome. We want to sound intelligent. And we want to make predictions that sound smart. And it doesn't have to be that way. We can think. I like to think in terms of probabilities. So there's a chance that environment of regime change that we've talked about, the tangible 20s, comes to pass. There's a chance it doesn't. So, how does the portfolio? How do portfolios look to try and balance off those risks and those probabilities? That's how I like to think about it, rather than we should be all in on Shell and Rio Tinto and China and EM because lines on a chart in it.
I know, and it doesn't work out, and all of a sudden you're a forced seller of something that hasn't done well, which is the whole point.
I think again that makes a lot of sense as to why we manage portfolios in the way we do. We think about regions. We take the US, and we want within that to have our best growth manager, our best value manager, our best manager at a barbell approach that runs, has a view on that as well, and then we can overlay it with certain thematics, albeit in small position sizes, but whether that's a global energy transition fund or a specific healthcare or whatever else each individual investment manager would like to do, but we certainly think about, as we know, running a portfolio on a very balanced basis, because it is as we know, it's impossible to predict for certain what is going to happen. I think we probably lean towards the same way in terms of the next 10 years will look very different to the last 10, but there's nothing certain about that, which is why we still have positions in the very good mega kind of tech businesses, albeit probably smaller than we might have done previously.
Yeah, okay.
Agreed.
Oil stocks, so these are the 4 oil majors, Shell, BP, Chevron, Exxon. The blue line is the oil price. There's a bit of a disconnect that's opened up here. I wrote about this in January, and if anything it's got a wee bit wider. First of all, why do you think the oil stocks are outperforming the commodity, first of all?
Well, they probably underperformed the commodity before, didn't they? I don't know. This is a sort of bit of reverse.
From 20?
Yeah. BP. Yeah, because BP and Shell collapsed with the oil price post-COVID, and the oil price recovered, and BP and Shell didn't really recover for a while, and now they've gone on a tear. So there's a little bit of catch-up, and I think there's probably a bit more confidence. I mean, this is a spot oil price, right? And very few oil companies sell lots of oil at the spot price. So you've got to look at the futures
price. Curve hasn't moved.
Future curve hasn't moved.
Yeah, and I think actually the majors track the future curve far more closely than the spot curve. I know Jamie spent all the time, oil and gas analyst, internally spent all the time talking to us about that. But yeah, looking at this chart, there is a big disconnect on the spot price. But I think, in truth, if we turn the clocks back to March, April last year, Russia had been in Ukraine for a month or so. Could any of us have predicted that the oil price would be where it is, based on supply constraints and tariffs? And it's quite I mean, it certainly has surprised me how low it's been and
It was the peak, wasn't it? Pretty much. 120, 130.
Yeah.
But I think the oil majors look a lot more investable again because dividends, cash flow, buybacks.
I think that's the key point here. You don't need the oil price to go boogaloo for oil stocks to do well.
Nope.
They were too cheap to begin with. Cash flow has become sexy in inverted commas
Well, it's
again.
jam today. It's a jam today story, isn't it?
Jam today rather than jam tomorrow.
I think the other thing is, remember they reset their dividends during COVID and they haven't been nearly as quick to re-ramp.
Shell cut their dividend for the first time
50 odd years.
Yeah, since the Second World War, wasn't it, I think?
Yeah.
But they haven't reset it as a percentage of share price. That dividend yield as a percentage is not nearly as high as it was, and I think that's quite important because there's much better coverage in terms of dividend cover of that payment, but also there is additional cash flow which they can reinvest in renewables and the energy transition, which I think for the bull case is incredibly important. There's obviously buybacks in there as well. I mean, what is it? Shell's probably 4% dividend yield, slightly under, probably another 8% of buybacks, which can obviously be turned off and on much quicker than dividend payments. So total shareholder return theoretically is from dividends and buybacks is a bit under 12%, which is much larger actually than the US peers shared from the next one.
I think there's one other factor at play here. For people that do a job similar to us, if you're looking at a portfolio during 2020 and looking at things that zigged while most other things zagged, oil and gas is probably one obvious area. Maybe there's a bit of that in the price if you're looking for something that's going to do okay in a similar environment to last year. I personally don't expect a similar environment to last year, but if you are, then oil and gas would be a natural sort of place to play.
Yeah, I think in previous cycles they've been quite wasteful of capital as well, made very bad acquisitions, overpaid for assets, typically at peak of market, when markets are peaking. And I think this year shareholders have, or not this year, but this time round, I think they're being more protective over the capital. I think shareholders have put more pressure on not to make those big wasteful acquisitions. And also they don't want to buy, essentially expensive exploration when we all see an end of oil and gas use, whether that's 20 years or 30 years. But instead of doing that, there's money being invested into, as we just said, into renewables and actually an energy transition in a different world to where we sit today.
I saw a chart not that long ago, and I might be able to dig it out, but it was of listed oil and gas majors, total capex is down 75% from where it was in 2015 in real terms. So they're spending 75% less than they were nearly 10 years ago finding more oil, which makes sense because all the reasons you just said were, do we still need oil in 20 years? No. Drilling a well in the North Sea is a 40-year timeline project. I mean, you drill a well and now and you've got 40 years to run out. Well, if you're only going to need it for 20 years, there's no point doing it. So why would you spend the money looking for it? But the bull case for oil in that case is that, well, we're still going to need oil for 5 or 10 years whilst we transition, and therefore if we're not spending much money looking for it today, that means that in 5 years' time there might be a pretty serious shortage. So again, the cure for high prices in commodities is high prices. As a farmer's son, that's pretty clear. But the reason that normally the cure for high prices is high prices because the oil majors spend lots more money trying to find more oil. And what you're saying, doing deals, spending loads of money finding more oil at the top of the market, you get a load of supply comes onto the market when this oil starts flowing, and then the price collapses. It's the same in every commodity. But this time round, if they're not spending more money looking for more oil, and instead they're protecting the balance sheet, they are buying back shares, they're going into renewables, etc., then there isn't going to be a supply response in the same way that there has been historically, which again underlines the kind of bull case on the medium term for oil. I mean, it's a view. It's not the view, but it's an interesting kind of thought process.
And again, if we go back to where we started the question on Saudi driving this oil cut because it's come out of their supply, they are trying to keep this oil price high because they know there's an end game in terms of the amount of oil they have. Not in terms of the amount of oil, but in terms of the amount of demand. And that, again, is why they are trying to diversify away from probably the most extraordinary asset that the world has seen, certainly in terms of oil. So there's a massive game in terms of what OPEC are doing, what the majors are doing, and then what consumers are doing, and where the demand is. So, it's fascinating.
I mean,
lots of moving parts.
Lots of moving parts. My sort of personal view is, it's a fairly big assumption to think that the oil companies have suddenly got religion about capital discipline. We'll see, but maybe that's because I walked into my first job in 2011 at the end of the commodities super cycle, so maybe that's my bias. Just moving on, a related point, we've talked about cash flows and things. This shows you over the last 12 months that a rudimentary measure of dividend investing, so a high yield dividend strategy, has outperformed global stocks in general over the last 12 months. For the record, over the longer term, it's been absolutely walloped by the stock market in general.
That's just sector, right? Presumably that's high dividend yield index is going to be underweight tech, overweight commodities.
100%. But my sort of related question to that is, when the conversation for someone that's looking for an income today is, as we've discussed, very different to what it was, 18 to 24 months ago. How do you think about income generation? Is it, I'm going to answer my own question here, it doesn't make a huge amount of sense to just restrict yourself to one type of style of investing, I don't think, just because you get a dividend, right?
I mean, I think most of us have moved away from investing for income specifically and towards a total return approach. Had you stuck to a dogmatic income mandate for the last 10 years, you'd have missed Amazon, you'd have missed Microsoft, you'd have missed Netflix, Meta, you'd have missed the US equity market because the yield is...
Might have been quite pleased to miss Meta for a period of time there.
Yeah, because the yield is 2%, whereas in the UK 5-6% has been the norm, but the capital value has gone nowhere in the UK market for a long period of time.
Yeah.
So certainly in the last few years we've tried to steer clients away from this kind of dogmatic, I want income, just clip the coupons and just get something of the yield. Instead, my portfolio is worth £100,000 and I want £4,000 a year, and you take it out of the total return, so it's capital plus income. But people today, actually the landscape's a lot different, as we talked about before, because you can now get 3.5% on gilts, you can get 5.5% on corporate bonds, you can get property market is giving much more generous income, so you don't necessarily need to chase income in the same way, because the opportunities are wider today than they have been for some years.
I think that's, a lot of our clients are asset rich, income poor because of the demographic of who they are, and completely echo what JR said in terms of, if a client requires, let's say, £24,000 a year, they just take a monthly standing order of £2,000 a month, and it's up to us to generate it through income and growth. And again, that allows us to be more tax efficient as well, because as we discussed in the last podcast, the difference between buying a gilt with a 5% coupon and a gilt with 0.125% coupon, although the actual income's not being produced from a portfolio point of view, the total return can be reduced. It can be produced, and we can absolutely create that for clients through either reducing holdings when the time is right, or holding small amounts of cash to pay out to cover that monthly income.
The best sort of argument I can sort of think of to come at it from the other way, there's almost potentially a behavioural element to holding a high dividend paying stock. You think, well, if I'm getting my 5-6% per annum, as long as who cares? Not quite who cares what the share price does, but it can be easier to sit through periods of volatility. I mean, that might be a simplistic way of looking at it, but there is an argument for that. Some people do think like that.
The downside is that it would have been great, but in 2020, the quantum of dividends on the UK equity market fell 35% in 2020.
Yeah.
Because the oil majors all cancelled, the banks were all told to stop paying their dividends, and it was probably as bad in 2008-9. So you'd be slightly mindful that those dividends can go awry.
Guaranteed.
No, I mean Compass and Shell. Shell cut the first time in 50 odd years. It's not back to the level it was. Compass cut because no one was using catering businesses because we were all stuck at home and not in the office. So there's loads of these businesses that, great businesses with a good sustainable dividend and growing dividend, to all of a sudden the world changed. So yeah, you just need to be slightly careful about that, but I get the behavioural side of it, definitely.
It's a simplistic argument, I think, from my perspective, but it's the best reason I can think of. You never want to narrow your investable universe.
No, and
unless you really have to.
Yeah, and I think, you know, you don't have to go too far back when, if someone said they wanted income, you put together a mainly UK equity portfolio with some corporate bonds and some gilts, and it would produce, John said, 5.5–6%, and you draw the income, and that was it. But actually, the growth of that portfolio was very limited, and I think if you put inflation on it, actually the value, if you weren't reinvesting those dividends, you're much better off on a total return basis.
Yep.
Yeah, speaking about the total return, this is something we've spoken about a couple of times. So, just price return versus income. So this is for MSCI World, isn't it?
Yeah, the red line is when you reinvest your dividends, and the blue line is effectively not taking your dividends.
Just price, and this is the
It's
same.
more stark in the UK. Yeah. So for the UK, I mean, you can see that the capital value's gone basically nowhere. I mean, it is up a little bit over 20 years since 2000, the peak, but not a lot. But if you'd reinvested your dividends, you got an 8x return, haven't you, since '94? It's quite nice.
Extraordinary. Yeah.
This to me is an advert for buying accumulation units and funds rather than income.
Yeah.
Yeah. And in the old days, well, we don't really do it anymore, but you used to be able to
In the old days.
In the old days, you used to be able to opt for drips, didn't you, on your within your nominees to have them all reinvested.
Really?
Could you?
Yeah.
In nominee?
Yeah.
I didn't know that.
Yeah. We used to be able to sign a form and get them reinvested.
Sounds like a CGT headache.
Do you know it's always a nightmare when you get people who bought British Gas or something, the nationalisation, they've got 3,000 share certificates with all the dividends.
Lloyd's BP on the drip, and they've got the first certificate, which is 100 shares, and then they've got 20 years worth of 3 shares, 4 shares, 5 shares, 6 shares, and they give you a stat like that and go, there you go. You know what I'm going to do with that?
Jack
Give it to someone else, yeah.
Don't do the same.
Those days
You had
are
it off
over.
as well. I mean, this in many ways is a very simplistic point, but simplistic things, really basic things, reinvest your dividends, automate it if you can, just gets you a far, 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 far better outcome than if you hadn't done that.
Yeah.
Eighth wonder of the world,
Compounding on your interest and your growth as well. Bit of a left turn. This is a story that's come up this week that's thoroughly depressing. That I've been speaking to about with some colleagues in the office. Craig Bellamy, current assistant manager at Burnley, former professional footballer. If you hadn't heard of him, international for Wales, of course. Has said that he's basically bankrupt, made a lot of money, I think it's fair to say, during his playing career, hasn't gambled it, hasn't spent it profligately, has just given it to the wrong people to invest. We had a look at an article that we produced here as a firm, I think it was last year. 60% of Premier League footballers declare bankruptcy
within 5 years of retiring.
60?
Within 5 years?
60%. It's absolutely
And this isn't,
extraordinary.
this is the top echelons of...
This isn't like League 1, League 2 kind of 100 grand a year.
This was Premier League.
Wow.
I mean, I don't know what first of all, this is just thoroughly depressing, and obviously if you're dealing with someone and speaking to someone about your finances, please check that they're on the FCA register. I mean, what behavioural lessons can we take from this, if any? Because by the sounds of things, this chap is trying to do very much the right thing and has just met the wrong people.
Stumped. I'm gone. You go.
I think that part of the problem is, these young kids get such a huge amount of money at such an early age, when in reality there's no education around what money means. Everyone at the football club has a sports car, a card to a certain bank. They're going out, with their mates and buying tables and drinks for everyone and the rest of it. And I think it's getting used to that extraordinary amount of money. And I'm sure the opportunities come along I know a mate who's done this, he's bought this property in Dubai or done this property scheme or this film scheme or whatever else, and you can earn 2, 3x, 4x over a few years. And that's just an exciting thing to look at. And if everyone else is doing it, they probably want to get involved as well. Whereas actually sitting down with a proper wealth manager or financial planner or someone like us, and we look at historic returns and say, for a balanced strategy, historically, over the last 15, 20 years, it has returned 7-8% per annum. That just doesn't look as exciting as what they potentially can do. Now, we all know what the potential can do and often does do. The learnings from it, it's really difficult. It's trying to get the right people in front of the sports people at an early age and almost doing an education around what can happen and actually what 7-8% return a year on a compound basis can look like into retirement, and potentially what that income, what those investments can generate as an income. But let's put it bluntly, if you're earning 100 grand a week as a footballer and you've done that for your playing career and suddenly you retire, you're forced to retire. Most footballers don't have the choice to retire, they're forced to retire. There's probably the mental side of what do I do with my life? And they're used to spending money, which is going out, having fun. And you can imagine how quickly it can disappear. And suddenly you're being told, oh, you've got to live off, let's say, 5 grand a week instead of your 100 grand a week. That's a really hard. I know it seems completely mind-boggling from where we sit and the normal person sits, but that's a massive lifestyle adjustment of not being able to take all your mates out the whole time. I presume a lot of your friends, probably hangers on that aren't friends if you haven't got the money as well.
That's the other slightly dark element to it. There's lots of benefits of having money. There's plenty of downsides as well, and unscrupulous characters attracted to probably is one of the major downsides I would suggest.
The problem is though, sat in a meeting room with Husey talking about gilts and Shell and Apple. It's just not very exciting.
It's not a property in Dubai, is it? No matter how exciting it can make the 2025 gilts on.
There's a global millennials fund I can think of that invests in Nike and
brilliant.
But I think I don't think this is an investment strategy question. I just think that there are bad eggs out there, and if you're doing your due diligence, people, we sit in front of people and talk a lot about the granularity of what we're going to do for them. You've got you've got to be very careful with who you deal with, I suppose, is the executives.
I think in reality it's down to the clubs.
I think they're better now. I think the clubs have got more of a duty of care these days, and I think things are better than they were even 10 years ago.
But it's the agents as well.
Yeah.
I mean, how many players have agents that are their mate or whoever, family member or whatever else, that in reality is earning a living from that playing person? And I'm sure there's big commissions taken, there's slippage of funds, there's
all sorts.
If you invest in this property scheme, whoever's doing a property investment, there's a backhander to the agent or whatever else. It's very difficult. Allegedly, of course, never happens. But I mean, lessons learned. It's
good for him speaking out about it. That's what I would say.
Yes.
And if more people do, and the message gets down to the younger guys at the clubs, and they've got to watch out. They've got to be careful. It's their money. They've only got 10 years to earn, and they've got 15 years to earn, and they've probably got 50 years to live off it. Yeah. So, yes, you're earning £2.5 million a year gross, maybe, or if you're Cristiano Ronaldo, you're on £20 million a year gross. So if taking home half that, your savings rate needs to be really high, because you've got to have that capital available in whatever form. It doesn't need to be in Nike and Apple and Amazon and gilts. It can be in Robbie Fowler's got the biggest property portfolio.
Yeah, he's put himself forward for the Northern Ireland job a couple of times.
Really?
One out of left field. There was I'm reading Nick Majuli's Just Keep Buying at the moment, and the point that he makes. What's the point in investing? One of the major reasons for investing is converting your human capital into financial capital, and your human capital, your earnings potential as a footballer is so small. It can potentially be really tall, but you've got to really quickly convert that into financial capital. As much financial capital
as you possibly can.
Because you're going to be around for a while.
I mean, maybe the lessons are you've got 10 years of earnings power. Someone puts a calculation together, which might be difficult, of this is what you're going to earn. If we take that figure and run it over 70 years, add some inflation in, this is actually what you should be living off on a weekly basis, and it will be a tiny number. but it's almost someone very sensible sitting at the top, almost sitting there saying, look, this is reality. But it's just education around, around the club, around, different players, and it wouldn't take long for the senior players to explain it properly to the youth players and the rest of it. But I'm sure as we, hopefully that 60% starts to fall, because it's incredibly sad.
Again, I don't think that's just limited to sport. There's an assumption that if you're wealthy, you're financially literate, and that's not necessarily always the case.
Yeah.
And I think the improvement needs to come.
I'm sure it's the same
in terms
as
of financial literacy.
I'm sure it's the same for, the music industry or whatever. Fine, they'll have royalties and the rest of it. But
financial services.
Financial services.
I think there's improvements we can be made across the board, obviously, and regulation hopefully helps. Okay, let's move on from that one. I think this is going to be a bit of a story for this year. We had an environment last year where the economy pretty materially outperformed stock markets. I wouldn't be surprised if you got the opposite over the during this year, basically. Stock market, as we discussed last time out, is not the economy, and the stock market can do very well in spite of a roaring economy or an indifferent one or a poorly performing economy. But I just thought this was interesting. So if you look at this is the growth of the US economy over the last 10 years. This is the growth of the US stock market over the same time period. I haven't been able to overlay them over each other, but believe me, the stock market wallops the US economy.
But it does.
And this is the same but for China. So you've got a Chinese stock market that pretty materially underperforms its economy. I don't know what the takeaway here is, if I'm honest, but stocks rely on one thing, and that's supply demand for the shares, and earnings growth can help that. But ultimately, it comes down to investor appetite to invest in a company and what are a finite amount of securities.
Stock markets are forward-looking, aren't they? So what you tend to find is that at the end of an economic cycle, and I'm generalising massively here, when growth is at its strongest, then the stock market is already looking across to the valley below because the economy is about to slow or go into recession.
Yeah.
And then when you're in the depths of the recession, that's when the stock market normally bottoms and starts roaring away. So March 2009, when the stock market bottomed in the financial crisis, the economy was still relatively strong up until that point. Actually, the economy suffered in 09, 10, 11, but the stock market had already fallen 50% into it, and it was across the valley on the other side coming out the other way.
Yeah.
So, usually the stock market will be able to look through and preempt what the economy is doing. But I agree with you, it's you can try and run as many regressions as you want between the S&P 500 and the US GDP, and you don't find much.
No, and the reason why, as we all know, with China, why GDP has outperformed the stock market is because the stock market is full of quite a lot of state-owned enterprises that are not run for shareholders, they are run for employees, and they run essentially to create jobs for the country. And actually, they've been very bad long-term investments, and they're not run for profitability. And there's certainly with the Chinese benchmark, there's a big element. I don't know what the percentage is, but I think it might be 30% of the Chinese stock market is SOEs.
State-owned enterprises.
Yes,
Yeah.
which ultimately that massively affects the performance of the overall market. I wonder what this would look like if you took the SOEs out, and whether it would be
better,
more in line. Yeah, I would expect it certainly to be better. But this is where entrepreneurs come in, and the stock market should outperform what GDP does, because you can put
businesses that are growing more than
exactly,
the
economy. And you have some leverage in there. You have financing power. You have idea generation.
I think you've just invented quality growth investment there. By GDP plus businesses.
Well, there you are.
Okay, last thing, just before we head on. Thanks for sending this round. Just before we've got Easter holidays, this might cheer people up a bit. The pound is back.
Well, just like the FTSE was back when we first started, the pound is back.
Are we going to become the death of death of everything.
That's
exciting.
Honestly, mate, I guarantee anything we talk about. I wrote something. I should have said, client. I wrote "Why is gold not working?" I think in October last year, and the gold price since then is just a straight
Yeah.
line up. So just in time for the Easter holidays. If you're going away on holiday, this is probably good news. Pound's up a
Pound's
bit.
popping up a bit. So if you go into the US, you can now get a whole $1.25 to
Dizzying
pound.
heights.
Well, I mean, it's funny, isn't it, that the Liz Truss quasi-Kwarteng mini-budget debacle, and the pound broke $1.10, didn't it, to the downside, and got down to 104 intraday.
Yeah, it did, yeah.
Over the weekend, wasn't that?
Investment banks were falling over themselves to write about the pound breaking the buck, and that was the low. That was it. That's when you should have been loading up on sterling. I mean, have we had good news in the UK in the last 6 months? No. What we have had is news that has been a lot less bad than we all thought it was going to be in October.
I think it
And
will.
it's an expectations game, right?
Absolutely.
Things are not great out there, albeit if you walk around London, it's pretty packed. But it's just those worst kind of
Worst fears.
fears of October in terms of everyone's going to be bankrupt, living in cold houses, and unemployment's going to the moon. It's just not happened. And here we go. The sterling's up 25% since.
And it's broken its 200-day.
I mean, yeah, if that's what you're into.
Look at you charters.
your RSI on the bottom pane here
Tell
is
us, mate,
approaching overbought.
Charting
so-
for dummies before I
Yeah.
come up here. Yeah, I mean, that's just it, right?
Time to book your holidays.
Yeah, I mean,
But
it's
they're
difficult
not-
to know what to say. I mean, this is basically, if your currency is the share price of your economy, then things look certainly not as bad as they maybe did in the dark old days of autumn. But this does have an impact, I suppose, on some.
This is relative to the dollar as well, though, right? So
Yeah,
we'll be slightly
that's
careful now. This is
important.
sterling relative to dollar. So the euro chart doesn't look dissimilar, but actually it's a little bit more stable against the euro. You can put it against the yen. You can put it against a basket. It might paint a slightly different story, because the reason that sterling popped to 125 yesterday was there was some weak data in the US. So the USD side of the ledger was a little bit weaker than people had anticipated. Therefore, if there's no news out of the UK and the news is worse out of the US, you expect the dollar to fall and the pound to rise.
Potentially rates might have to be hiked slightly further in the UK than the US. There's a little bit of that as well, which
Hopefully not.
I'm sick.
That's all right.
It was cancelled as well. It was off today. Someone's going to have to teach me how to work this.
They're telling you it's time to wrap it up. Who you got the Masters? And there is a right answer.
Rory, obviously.
Obviously.
I mean, obviously it's been
The
Rory.
main man.
I mean, it would bring me so much joy if Rory won it. So I see you wearing your Masters green jumper. Very
Yeah,
good.
I know. Well, someone tried to pitch me Brooks Koepka 50-1 today, but out of principle, I'm not going to back him. What are you up to over the long weekend, Husey?
We have quite a few Easter egg hunts with the kids.
Love that.
We taking bets on that.
we say go, and I'm involved as well, so I'm going to take all the kids chocolate eggs.
Oh, brilliant.
But no, they love it. They're 3 and coming up to
Is
3 and
there a
5.
particular Easter egg as a fan favourite in the Hughes household?
Kinder?
Kinder?
Yeah.
You can make the toys.
Yeah, no, it's good.
Things are going well over there, clearly. Boys, that was fun. Thank you very much.
Good.
See you next
Good
time.
job. Thanks very much.
Thanks for joining us, folks. As ever, submit any questions that you've got to david.henry@cultureachievia.com. Have a great time over the long weekend, and we'll see you soon. Bye-bye.
Bye-bye.